Morning, all.
Good morning.
Bit of a slow start today. We'll wait for some more people to join us. Europe is here. Europe is in the house. Awesome. Colorado is coming in. She's not there, but her video's on. Oh, she's here. Shh, Julia's here. Just kidding. Hello, good morning.
Good morning.
Josh, all the way from New Jersey. Welcome.
Hello.
What part of New Jersey are you in, Josh?
I'm from northern New Jersey,
Okay.
Essex County.
Okay. Can you be more specific? What's the town?
Milburn.
Okay. Awesome. All right. How are we all doing today? Doing okay? People a bit tired? Yeah. Hopefully it went okay for you all yesterday at the exam. I would anticipate that results will be out today. Sometime. Usually the way it works is we probably release it after the markets close, meaning after everyone's been in class, so probably in the evening sometime. The one thing I would say is that I believe tomorrow is the final day to drop with a W. So for those folks who are contemplating that, just be aware of that date tomorrow. Okay, does everyone know what I'm talking about? Okay. And also a reminder, obviously we have conventional grading this semester, unlike last semester where you had the credit, no credit option. Obviously this semester we don't have that, okay? Anyone got any questions? Okay, everyone's eating breakfast, looks like. Shelby, what are you eating? Audrey, what are you eating?
A bagel.
Cassie, where's your big drink? Oh, you got it, good. Whew. Okay. All right. No questions. All right. Audrey, did you want to say something?
I was just going to say I'm eating steel cutouts for those interested.
Oh, very good. Very healthy. Not your regular, like, instant microwavable. It's steel cut oats. Any particular brand you want to mention? Or you've been sponsored by someone? No?
No, I can't. NCAA doesn't let me do that.
Ah, I got it. Always thinking, always thinking. All right, I love it. Hey, so listen, today is what I call a transitionary day. So let's chill today. Let's try to have some fun. Yeah. That's where F stand in finance stands for fun. Okay. We're going to do so when I say transitionary, we're going to transition from up until this point. Oh, Grace, that looks delicious. Is that your fruit smoothie?
Yes.
Okay. Woo. Do you go to Starbucks to get that?
No, I make it.
You make it yourself. Okay. Do you personally make it, or do you have like a chef or someone?
No, I make it.
Oh, very good.
Yeah.
Okay. So it's transitionary because we're going to switch away from consumer finance, what I call consumer finance. So my mortgage for my home, the loan for my car, the interest rates, they're all retail. They're all related to consumer finance. They're all related to us personally, right? Now we're going to switch and we're going to start thinking about corporate finance. So it's finance as it relates to companies. And guess what? They do mirror each other. So if it's pertinent to you, probably pertinent to a company, right? And vice versa. Okay, so some of the concepts are the same, but we're now going to change our vocabulary and talk more about corporate related issues. Okay, and that's part of the objective today, is to talk about vocabulary and introduce you, or maybe reintroduce you to some of the vocab. All right. Okay, so if there are no questions, are we sure there's no questions? Come on. Someone asked me a question.
Okay, I'll ask you a question.
Thank you, Cassie.
Do you know what the average is?
Someone asked me a question about the exam. I don't know the exact average, because as of like before we came on air, the Professor Newell just changed some of the answers to accept certain answers. But I will say it was harder than the first exam. So the first exam did not have a curve, if you recall.
Mm-hmm.
This exam, I think, will have a curve, a positive curve, meaning we're going to shift scores upwards, right?
Okay.
Did you all think it was easy or something?
I don't know. I thought it was fine, but now I'm scared. Like, I just want to know now.
Oh, don't you see?
I'm nervous now.
It's okay. Don't be nervous.
Well, okay.
It's easy for me to say, right, Cassie?
Yeah.
Yeah. Sorry, I empathize. Been there. So yeah, the average was no matter which way you look at it, it's going to be lower than 80. Okay. Just bear with
I
us.
have a question.
Bear with us. We'll get you the result as soon as we can. Yes. What's the question for who? Hassan.
Yeah. There was this one question where we had the EAR was given, and it didn't say with compounding, but it also didn't say with no compounding. So it just gave the EAR. Does that mean that we get to manipulate it like however we want?
No. No, there was only one unique answer to each question. So,
No, yeah, but I mean, like, to get to the answer, like,
yeah.
did we have to stick to the EAR as a yearly, or could we bring it back to IYR however way we wanted?
No, I don't think you could, because I think in that case they were telling you it was an annual rate, and I don't know the question you're talking about, but I'm pretty sure that cash flows were probably annual cash flows. Or the
It was
payments.
actually quarterly.
Oh, okay. Well, so then you
But-
have to bring it to quarterly.
Yeah, so that's my question. Is like, did I have to keep it as yearly? Because it didn't say with compounding, and it didn't say with no compounding. So
Yeah,
the question told us that there was quarterly payments, and then the question also gave us an EAR. So I could have changed the EAR to a rate. No.
You had to change the EAR to a quarterly. You had to. So in the class, we said what governs what rate you use is the period of your payments. So if you pay monthly, you need a monthly rate. If you pay quarterly, as in that question, you needed to bring it to a quarterly rate. You couldn't have left it as an annual rate. And you couldn't have put it as monthly because that's not quarterly, right? Okay.
Got it.
Sorry, I didn't understand your question to begin with. Okay, so all right, let's dig in then. Okay, everyone see the slides? Okay. So today we're going to talk about earnings and capital structure, and also balance sheet, which is related to capital structure. From the book, it's chapters 1 and 2, and you may have covered this material if you've done SM 131 before, or you're taking it now. It is a prerequisite, so I assume people are taking it now concurrently, which is fine. But you should have already talked about the counting lecture in SM 131. Can I get a nod of people if you've done it? Anyone taken SM 131 this semester? Yeah. So did you just do it, Julia? Can you take yourself off mute? Did you just cover accounting?
Yeah, we just did it like a week or so ago.
Beautiful. So it's going to be fresh in your head. Awesome. So we're just going to reinforce it. And again, we're trying to get you to sort of switch gears and introduce you and make sure the vocabulary and terminology is clear. Okay. All right. So you were introduced to 2 statements, right? There's really 4 statements, but the 2 that most people talk about are the income statement and then the balance sheet, right? So we're going to focus on those 2. The other ones are the statement of retained earnings, which goes along with the income statement. But then the other major one is called the statement of cash flows, which we're not going to cover. But actually, if you were to ask me what my favorite accounting statement is, I know you're like, how lame is it that you have your favorite accounting statement? But yeah, I would say the statement of cash flows is the favorite. But most people tend to focus on income statements and balance sheets. So we're going to do that, okay? Okay, so where we get the source of information for all this. So we're trying to express everything in a common language. So just like you have a dictionary for language, we look for, well, where's the information that we're going to look for? And you could look at it on Yahoo Finance if you want, but we will look at it usually through annual statements, right? Called 10Ks, or quarterly statements called 10Qs, right? And so we'll go back to those source information, and that's really where it has the best information, right? And we'll go to the SEC website. There are plenty of websites that store them, but the SEC website has them. So you go on to Edgar, which is their database, and you can find all the filings that companies are required to make, right? It's not optional, right? They're not doing it out of the goodness of their hearts. They have to file this information if they're a publicly traded company, okay? With the SEC, the Securities and Exchange Commission, right? So I will encourage you to look at Edgar filings. whenever you're doing research on companies. Don't have to do it as much in this class. We will have one exercise in a couple of weeks that you'll have to do. In that case, I would ask you to look at the 10Ks and the 10Qs, okay? Yahoo Finance is great for quick answers, and I will use it in class. But how much do I pay for Yahoo Finance? Julia, you're doing this, right? 0. So therefore, what do I get? You get what you pay for. So if I paid 0, I get 0, right? So the information is kind of iffy, right? So go back to the source. In this class, we're going to pull up Cheesecake Factory information. It's dated, but we're going to use their information. Yeah. Okay. Balance sheet. Balance sheet. Do we all know what a balance sheet is? Oh yeah, Professor, that's when I get out of bed in the morning and my bed covers are everywhere and they're just sort of hanging on the bed, off the bed. You know, balance sheet. Never mind. Hassan, right? Really bad dad joke, right? Embarrassing. Balance sheet. So the thing about balance sheet is that it has to balance. And the idea is that what I own has to be financed somewhere, somehow. So what I own has to be financed either by debt or equity, and they have to be exactly equal, right? So we say our assets will be exactly equal to our liabilities plus our equity. Liabilities is what we owe to third parties who are not how should I say, not part of the ownership of the company. Equity is the ownership of the company. Okay, so assets, stuff purchased by the company, liabilities are dollars that are borrowed by the company, and we're talking about financing. So they're dollars borrowed by the company. Yes, you would say, oh, there are other liabilities like accounts payable. That's where you owe your vendors, right? Yeah, okay, but we're simplifying it here. And then the other portion is the equity or the owner financing. So it's the dollars invested by the owners, usually at the start of the company when they do an IPO, right? That's usually the most fundraising that you get. But in addition, any earnings that you haven't paid out over the life of the company, if you keep those earnings, it's like you're going to pay them out to your owners at some point. So we call it retained earnings, right? So equity consists of two things: the amount that your investors actually invested in the company, but then any earnings that you haven't paid out over time. All right, everyone cool with that? And it's at a single point in time, right? So it's usually when we do financial statements, your fiscal year is the same as the calendar year, it'll be December 31st that you will just have a balance sheet. It's like you took a camera and you took a snapshot. How much money did you have on December 31st? And how much did you owe on December 31st? And how much equity did you have on December 31st? Okay? Questions on that? Okay, so as we go forward, for the rest of the semester, we're going to spend half of the semester talking about debt, which is this box that I'm circling. And we're going to spend the other half talking about equity ownership. And we're actually going to talk about how do you value equity for the most part, right? And how do you value debt? Here we're going to talk about bonds, and here we're going to talk about stocks. So if you ever hear people talking about stocks and bonds, stocks belongs in equity and bonds belong as a liability. It's basically a loan, right? That's all a bond is. It's a fancy word for a loan. Okay. So in this example, here's a little picture of a balance sheet, and it says, oh, for this company that is a dog grooming company, you put $500 of your own money into the company, and you borrow $100 from, let's say, a bank. So in total, you have $600, but you spend $400 on supplies like leashes, dog beds, and dog treats. And therefore you have $200 left over, right? So our balance sheet would look like this: $200 in cash, $400 in supplies, and then a loan of $100 from the bank and equity of $500. You can see my total assets are 600. My total liabilities plus equity is 600 also. My balance sheet is balanced. Okay. Okay, that's a balance sheet. Everyone okay with the balance sheet? Really simplified view, but if you look at any public filings, there are only a handful of accounts, right? Can anyone think of some assets that you might see on a financial statement? Hassan?
Like if the company uses trucks, for example.
Beautiful, right? So if you think about FedEx, where they actually might own a lot of their trucks, I imagine that's actually a pretty whopping big number for FedEx. They also own planes, right? So that's a lot of money. Yeah, okay, good. Anything else? Other assets?
Land.
Land, okay. So if company owns land, in particular, if you have a real estate company, that's pretty much all they own is land and buildings on that land, right? But if you also think back to, it used to be that like retail stores, they would own the land that they built the stores on. It's less popular these days because usually retail stores will lease the land and lease the actual structure. But it used to be that retail stores actually had two huge assets. One of them was land and property, and the other one was just the inventory that sat inside the store, right? And then what people discovered, ooh, if I bought this retail store, like let's name the retail store. What should we name the retail store? Kmart? Caldor, yeah. So companies got taken over and pretty much stripped bare of their land, and they sold off the land because the land was actually worth more than the business itself. Okay, cool. Any other things? Come on, I just mentioned one of them.
Machines.
Who said machines?
Niharika.
Niharika, yeah. So manufacturing companies, they're going to have a ton of machines, yeah. If you think about auto manufacturers, right? Think of all the robots that they have in their factories, right? Very capital intensive. Awesome. Other ones?
Factories, plants.
Factories, plants, okay, that goes with what Audrey said. You know, it's what we call, in total, we don't list them all together like factories, land, plants, machinery. We call it PP&E, property, plant, and equipment. Yeah. Okay, cool. Anything other than property, plant, and equipment? I'm looking for a very specific thing.
Inventory.
Okay, who said inventory?
Audrey.
Audrey, inventory, land and inventory. Audrey, you know your assets, don't you? Inventory. What's inventory? That's a fancy word. What is that?
It's like, I guess, like what you're selling in most cases.
All right. So if I go into Lululemon, which I'm prone to do, you know me, with the yoga pants. If you go in there, this, oh boy, shelves are full of inventory, right? You have to account for that, right? And sometimes if you go into manufacturing companies, maybe they're blocks of wood or there's blank pieces of metal or steel or plastic, right? They're not actually finished goods, but it's still inventory that they need to use to actually produce their goods. So that's all part of inventory. Cool. All right, everyone okay with assets? Liabilities, like I said, we're going to talk about it a lot, so I'm not going to cover it. I want to know one, the liability other than debt.
Insurance.
Sorry?
Insurance.
No, so insurance usually, Josh, I don't know what you mean by insurance. So can you elaborate? Because
Just like any general insurance. Would that be an asset?
no, so when you, it could be, but usually when you see insurance, it's you paid money for an insurance policy, right?
Yeah.
So that's what we call an expense. So usually we'll see that on the income statement.
I see.
Right? Sometimes you pay a full year of insurance, so actually you kind of have prepaid the insurance, so it might be actually a prepaid asset, not a liability, if anything, but it's usually not called out. A liability. So just
Accounts
like,
receivable,
okay, so who said accounts receivable?
Alex.
Alex. So accounts receivable, tell me what accounts receivable means.
Aren't those like stuff that you can receive from other people? So like people or accounts receivable. So if people buy your inventory on credit, right? So like with a credit card,
Yep.
right? Then they owe you money.
Yep.
So that amount that they owe you is an account receivable.
Right, okay, so cool. So that means that, okay, so let's say I manufacture the speaker, right? So I sell this to Target, right? Target, when I drive up in my truck and I drop off the speakers, Target is not going to say, oh, here you go. Here's some cash for you. Thank you for delivering the speakers. They're going to say, get out of here. We'll pay you whenever we want to pay you, right? Well, actually, you'll negotiate that, but they'll pay you whenever you negotiate it. So they usually pay you 30 days, 45 days, right? So that's money they owe you. Okay.
I thought
So,
that accounts receivable was on assets.
indeed it is. So I was just getting there. So therefore, if they owe you money, is that an asset or a liability? I was going to go back to Alexander.
Sorry. Yeah, so that's an asset.
It's
So
an asset, okay? It's good.
accounts payable.
Okay, so Alex really meant to say in accounts payable, right? And Alex, take yourself off mute again and tell me what accounts payable means.
So accounts payable is the opposite. So if you pay another company for like manufacturing goods, right, to produce your own goods, and
Yeah.
you pay for it on account.
Yeah.
So with like a credit or something, right?
Yeah.
You owe the other company.
That's right. So I'm Lululemon and I manufacture those yoga pants, right? But I need cotton or lycra or whatever the material is that goes into it, right? So I buy it from DuPont if it's lycra. So I owe them and they say, it's okay, we'll give you 30 days to pay us back, right? And so that's money that I owe them, right? So that's an accounts payable. It's a liability because I owe them money, right? So that's the sort of the main accounts payable or the main liability we're going to talk about. But for us, we're going to focus on liabilities will be debt, and equity will just be common stock. Okay, cool. Let's move on. All right. So we're going to explore how earnings, blah, 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 impact the value of the company, right? So today we're going to sort of use what we've learned in the first few classes about cash flows to sort of build an income statement and then value a company, or actually make some management decisions based on the information that we're given. Okay, so we're going to do a case here in a couple of minutes. Okay. Okay, and I said stock is the owner's interest, bonds are debt. Okay, we already went through that. Okay, so here's the way an income, so we talked about what a balance sheet looks like. Now we're going to talk about, well, what does an income statement look like? And an income statement is not one point in time. It's not December 31st. It's a period of time. So it's usually January 1st to December 31st. And it's all the activity that happened in that time frame, right? I bought some inventory. I sold some inventory. I paid some people. I bought some insurance. Yeah, I paid for utilities, I paid rent, blah, 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 so on and so forth, right? So the way we categorize the income statement is then, oh, well, I have revenues. Revenues are exactly the same as sales. It's a fancy word for sales. So I have revenues, what I sold to my customers, and I subtract out the expenses. And the expenses are usually variable expenses, how much is associated with the product, and then fixed expenses that I have to pay all the time. But in total, it's the expenses that I needed to spend in order to run the company. Okay, and what's left over is my net income, also known as my earnings, also known as my profit, right? So three terms for the same thing: net income, earnings, or profit. And if you're from England, maybe, you might also call it turnover, but we're not going to call it turnover because that's what they serve in Denny's, you know, the turnover, the flapjacks. Okay. Okay. So I want to do this little case. Here's a dog. I don't know if this is Professor Newell's dog. This might be Professor Newell's dog. Actually, no, I don't think it is. So we're going to look at this case. It's called Amazing Pampered Pets. So in a minute, I'm going to show you where you can find it on Questrom tools. But what I want you to do is I'm going to split you off in your groups of 4 or 3. And I want you to produce, well, you'll see in a minute. I want you to produce 2 income statements. And we're going to say an income statement is essentially a cash flow. All of our sales are for cash. So it's all cash sales and all cash costs. But I'm going to have 2 options. One of them is to have this new product. All right, so we're going to have actually 2 new products. The first one is a bed that will massage your older dog as they sleep, right? Doesn't that sound great? Crap, I might use it when we have a 10-minute break. I might actually use that. So it massages the dog because apparently older dogs, they have a lot of arthritis and stuff. So actually a massaging bed is actually pretty good for dogs, right? So that's the first product. The second product is exactly the same as the first one, except now it has a voice recording feature. So you can record your voice for your little pooch. And you can say, wait, who has the dog? Dagny, you have a dog. What's your dog's name?
His name is Hennessy, but we call him Marty Feldman because the eyeballs.
Okay. So, what do you go? What message do you want to record for Marty Feldman?
I don't know.
Hey Marty, I love you, you cute little pooch, little Snoopy, with your
Sure.
with your bug eyes.
Sure.
Sure. Who else? Who else has a dog? Cassie, do you have the dog?
Yeah, I have 4 dogs. I have a
Oh,
bunch, so I
okay.
would need a lot of dog beds.
Okay. All right. And what would you record to your unnamed pet? Right. We still haven't determined the name of him.
Yeah. I don't know. I would just say that I love my dog, I guess.
I love my little doggy. Have a great way. Right. Okay.
Yeah.
All right. Or something like that. Okay. All right. There are 2 options for our 2 products. But you as a manager, you're going to have to tell me which one you want to do. Okay. So I'm going to be pretty prescriptive. What I want you to set out, and I would suggest, here's what I suggest. When you go into your team rooms, your breakout rooms, I would suggest one person pull up a spreadsheet on Excel and do these calculations in Excel. And it's only going to be 3 lines, right? But across the top, I want you to have, that was not the answer, by the way. I want you to have year 0, year 1, year 2, year 3, year 4, year 5, going across, right? And going down, I want you to have maybe units sold, revenues, costs, and then, oops, sorry, net income. Okay. And from that, we're going to assume the net income is cash. And from that, you can determine, what do you think you can determine? What do you think you can determine? Come on. This is related to what we've done already. So what have we done already that maybe you can relate this to? If I have cash flows each year, what can I calculate?
The IRR.
The IRR? Who said that?
Josh.
Joshy baby. Beautiful. I love it. What else can you determine? What other metric?
Net present value.
Thank you, Shelby. Net present value. And then once I have those 2 metrics, can I decide, make a decision on what I should do? All right. So I'm going to show you where the case is. You're going to have like 5, 10 minutes. Now, let's give you 10 minutes to put this together. And then I want you to come back and I want you to give me a recommendation. Which one should you do? Product A or product B? Okay. All right. Let me show you where these are. The case is, sorry. Doesn't even make. Okay. So can everyone see my browser? So if you go to Questrom Tools, go onto our site, and you will see down here, Class-7 case study, amazing pampered pets. And then it's a document here. Open it up. And it says, you're a product manager of amazing pampered pets. It's only 1 page. Don't sweat it. It's not a huge case. Determine for the revenues for each of the next 5 years for each version, right? Here's product 1 and here's product 2. And this is the information you have. How many beds you sold, what was the price, what was the cost per bed, how much you had to invest in that property, plant, and equipment, how much equipment you had to buy, how much maybe land or a building did you have to buy, okay? And it also has sales growth for each year, 3% for the first product and 2% for the second product. And it has discount rate of 15%, i.e. that's the cost of capital, that's the interest rate on your capital. You can find out what is the net present value. All right, any questions before I split you off into rooms? If you have questions during it, just send me a text in the chat room and I will answer it. I'll come into your chat room. Okay, is everyone okay? Is everyone excited to do this? It's going to be so much fun. And why don't you come up with a nice name for your Pampered Pets product if you have spare time, right, Hassan? Okay, here we go. I'm going to split you off. Good luck. Chit chat in the room, right? But you have to do some work as well. Breakout room. Here we go. See you later.
Morning.
Morning, Oliver. How are you?
Good. How are you doing?
Oh, fine. Hey, did you get many students coming to your session before the exam?
Actually, yeah, I had 2 people email me, but then I had 7 come.
Yeah.
So I was like, that's an improvement.
Yeah. No, I had probably about 16, but I had all sections.
Okay.
Do you remember? Interestingly, do you remember who came to your office hours?
Yes. Let me just look at the roster.
I'm just wondering if it's the same kids coming the same, just to hang out and see what's going on.
From our class, I had Queena come. Catherine, Mal.
Yeah, she came to mind as well, I think.
And then Jai, I think. And then the
Okay.
other 3 or 4 people were not from our section.
Yeah. All right. Good. Excellent. Yeah, the scores were not that great on this exam, but it was a lot harder, right? So I think it was. Hey, Leah.
Hi, Professor. Sorry, my computer just died. Can you put me back into the breakout room?
Which one were you in?
I'm not sure. I ran to go get my charger and I came back in.
Do you know anyone that was in your room?
No, I don't.
You didn't know anyone there. Hold on. I think this one with. Okay, I'm going to put you with Cassie.
Thank you.
Okay. What breakout room was that? 6. See ya. Yeah, so I think the average was, the median was, it's about 65.
Oh, wow.
Yeah, so I think there'll be about maybe a 15-point curve on this one. So, yeah, it was pretty.
I didn't expect that.
Yeah, well, I knew it was going to be worse than the first one, but that was, yeah, I don't know. I don't know. Our section, I think, was the better of the sections, but
Right.
not meaningfully so.
I just feel like people don't. They're just like, oh, it's online, so I don't need to prepare as much.
Yeah, I don't know what it is. I do think that, you know, a ton of people who normally don't get high points did well in the first, and I think they took their foot off the gas
Yeah.
and just sort of said, oh, it's okay. I'm doing a little bit of work. I'll be okay.
Yeah.
And it didn't turn out that way. All right. Well, I'm going to pop into these breakout rooms and see what's going on. Do you have any issues or anything going on?
No, I'm all set.
So if kids are coming to you asking for, oh, give me credit for this or that, don't get into that business. Just send them to me, and I'll.
Yeah, well.
Yeah, because you don't want to be caught in the middle between them and me, right?
Yeah.
So just punt. Tell them to get lost.
Okay. Yeah, I will do.
All right, let's go.
0 there. I'm not really sure.
Yeah, I think, yeah, that's what I did too.
Hey guys,
Yeah,
how you doing?
getting there.
Okay, so you could also share your screen with each other, right? So if someone wants to do that, you could just share it and everyone could copy the thing case.
I guess I could.
If you want, I mean, this is not a big deal. Just want you to get into the habit of what an income statement looks like and the language that you'd use.
When it says that it sold in year 1, for year 0, would we put 0?
Yeah, you haven't sold anything in year 0, and the idea is that in year 0 or today, the only thing you're doing is you're buying equipment and you're setting up your factory and all that, and so therefore you haven't sold anything yet. But year one is when you sell the stuff, right?
Is there a way in Excel to, like, instead of manually calculating like the 2% growth, can you do that?
Mm-hmm.
What's the equation for that?
So what you do is so Excel is awesome, right? And I would encourage you to play with it as much as you can. So what you do is you press the equal sign, and when you press the equal sign, Excel knows you want to put in a formula, okay? And so then you can reference a cell, right? So press the equal sign and then click on the cell that you want to grow. Okay? And then you say multiply that cell by 1 plus, what's the growth rate?
2%.
1 plus, I'd say 0.02, or you could actually put in 0.2 in the spreadsheet. And so you can reference those cells. So it's like it's a totally customizable calculator.
Where do we put the equals again? Because when I put the equals, it deletes the number that I want to multiply by, or the like 9660.
Okay, so let me show you right quick. Let me see if I can do a screen share. Where's my... Okay, can you see my spreadsheet?
Yeah.
Okay, so here I have year 1. And let's say I sold $10,000 worth, right? I know that's not the number, but just bear with me. And then I have year 2 next, yeah? So what I'm saying is, so these are revenues. This line item is revenues. So you want to calculate year 2's value, right? Yes?
Yeah.
So so I'm pressing equal, in that cell.
Mm.
And then I'm going to click on that cell. And then I'm going to press the multiplication sign, which is a star. And then I want to multiply it by, I'll put in parentheses, 1 plus, and then you said 2%, right? Okay, and I close the parentheses. So I wrote the formula, but I referenced that prior cell, right? So when I press enter, it should give me the answer in the cell, right? So you see that it grew it at 2%. Yeah?
Mhm.
And here's the beautiful thing, Grace. Once I have that, okay, let me just do this. I'll drag this across. Once you drag things across in Excel, it copies it. So that formula, I'll just drag it across. And I'm done with that line item.
Mm.
Okay,
Okay, thank you.
was that clear? Can you do
Yeah.
it? Okay, do it, all right? I'll stop share. I hope. Okay. Good luck. Hey, Oliver. Hey, I went into the first breakout room, and Jan Hu, I don't know if you know that guy.
Yeah.
So when we come back on, look at Jan Hu, and there's someone in the bed behind him,
Just relaxing.
just lying in the bed, female, don't know what's going on.
Picking up some finance on the way.
I don't know, might be sister. He might just live in an apartment, who knows. All right, just check it out.
All right, I'll take a look.
Correct.
Oh, look at you guys go.
Hi.
Hello. This is looking awesome, I think. This is exactly what I wanted you to do.
Mm-hmm. Well,
Wait, hang on.
Okay, so you gotta do the NPVs and the IRRs, right?
Yep.
Who's driving the spreadsheet? Shelby, is it you?
Yes.
Okay. Does everyone know how to do Excel?
Kind of.
What's that, Tiff? What are you saying?
Like I didn't know before, but like I see how Shelby was doing that, so like kind of know how to do that.
Okay. So Shelby, I wouldn't do it that way.
Huh? Oh.
So I would say the net income is just the sum of the revenue minus the cost, right?
Yeah.
Okay. So just put an equal sign. Is that what that is? Yeah, beautiful. All right. Okay. 2 numbers for each, NPV and IRR, and then make a decision and come back. Okay. Look at you guys go. That looks beautiful.
Wait, that being said, I think the revenue, we don't want to multiply it by 1.02 because we just multiplied the units sold by 1.02 because that's the sales growth, but the revenue is driven based on the number of units sold. So if you go to like the original, yes, see if you go to C9, so go one.
Times the previous year's revenue times 1.03.
Mm-hmm.
And then what about the discount rate?
I'm not too sure about that.
So why don't you guys share your screen? have one person share the screen, and you all can see what you're all doing, right? And you can copy it and recreate it.
Is the discount rate the interest?
Indeed.
Okay.
We said the
So
interest rate on equity is the same as the discount rate. We call them the same things, right?
so Goal, that's how you would use the discount rate. So when you're finding the net present value and the IRR, right? Or not the
Yeah.
IRR, but for a net present value, you'd use the.
Yeah, now I got it.
Are you guys nearly finished?
No.
With the first one.
Okay. Well, if it isn't the Three Musketeers. You
I'm
guys are
having troubles with the find the IRR in Excel.
Yep.
I don't
So
know how to use that function. I'm trying to set up this array, but it's like I'm having problems.
don't set up an array. You don't
Oh.
need to get that tricky.
Okay.
Maybe. So why don't one of you share your screen so you can all
I was trying to, but I need to log out, and I don't know if I'm gonna log back into the breakout room.
Oh, okay. Well, I'll reassign you, but Sgna, can you, or Catherine, can you share screen and you all can see what you're working on? So the function you want, Stephen, is called IRR. So just do equals.
Yeah, I understand that.
Sorry. So why isn't it working?
I don't know. I'm getting a hashtag number value.
Yeah, that's because your numbers are not correct. Because here's the thing, you have to have a negative and a positive, right? Negative and positive.
Yeah.
So if I'm guessing your capital expenditure at the start is not negative.
Yeah, I just put negative in front of the cell reference, and I thought that would make it negative. It doesn't.
Yeah. Just make that cell negative.
Okay.
So go into that cell and just say,
yeah,
and it might work. Okay.
All right.
Gotta go. Somebody else is looking for me.
Oh, yeah. It's like smaller than the revenue in year one. Hi, Professor.
We
Hello.
have question toward the discount rate. We are not sure discount rate means we should multiply by 0.85 or we should multiply by 1.15 for the year 2. Does discount rate same with interest rate?
Didn't at some point in our career in this class, didn't we say that the interest rate is also known as the discount rate?
Yes. Oh, okay.
Wait, so do you multiply by 0.85 times the sales growth per?
1.15.
No. When you're calculating the NPV, how do you calculate an NPV, Niharika?
With the discount rate?
Okay, so I'm just telling you the discount rate is 15%.
Okay, so
Yeah.
the discount rate is for NPV, but the sales growth is when you calculate it per year.
Yeah, and
Okay,
I'm told
that's what I
that
thought, yeah.
for one product it grows at 2%, the other grows at 3%, right?
Yeah.
That's the units. That's how the units grow, but then the sales price.
Okay.
Okay, so you'd use a discount rate for the NPV and IRR.
Yes.
Okay.
Yeah, not
you
the
don't need
revenue.
it. You don't need it for the IRR, right?
Yeah.
The IRR
Okay.
is.
Professor, so for instance, we transfer the value from year 1 to year 2, we multiply by 1.15, right?
1.15.
No, like 15%. 1 plus 15%.
No, why 15? Well, 15 is your cost of money. What does it say? It says you sold how many beds in the first year?
15,750.
15,750, yeah? Something like
Yes.
that. Therefore, the next year you grew it at what percent?
3%.
So therefore, it's 15.
Multiplied by 1.03.
Yes.
And
Yeah, so we don't need to care about like the discount rate for the revenue or the cost, but
Yeah.
like for the NPV.
Only for the NPV.
Oh,
Thank
okay.
you.
Thank
Yeah.
you.
Thank
I'll
you.
give you another 5 minutes. Are you nearly there?
Yeah, hopeful.
Xavier, you've been very quiet there.
Yeah,
Come on now, are you getting involved? So,
of course.
okay, good. Can someone share your screen with each other? So therefore,
Yeah, we have a shared Google Doc.
oh, you're getting tricky on us. All right. Good. I love it. Google Docs. See you in a bit. Seems like there's a lot of collaboration going on in this room.
There is. There is.
Oh,
We've been
no,
talking.
there's not.
Yes, we've been
We're all
looking
doing the
through.
calculation.
Yeah.
Okay, I just got the NPV for the second product. If anyone else did it already.
Hold on,
Still
I'm
calculating it.
What'd you get, Liza?
I got negative 233,337.7. Amazing. Okay.
Amazing. All right. Did you guys share your screen at all, or are you
No,
all?
I like was holding my paper up to the screen.
So when I suggested you do it in Excel, you just didn't hear that. You heard it, or you totally wanted to ignore me because you think I'm just don't know what I'm talking about, or
None of us knows how to work Excel.
how do you work Excel?
I've never used it.
Oh, it's so awesome. It's so much fun. You should do it. We'll do it in class.
Okay. That's what my dad says, but we always use like Google Docs and Sheets in high school.
Google is crapola.
I
Sorry.
know.
Google is, you know they're stealing your information, Alexandra, right?
I did not know that.
Oh, they know everything about you. Don't do the Google Docs, the Googly Docs.
I trust
Right.
them with my information.
What's that, Damien?
I still trust them with my information.
You do?
Yeah.
And do you still believe in the tooth fairy?
Not anymore, but
Okay, I'm just kidding. They're a great company. All right, so it sounds like you guys are nearly done. Yeah.
Yeah.
Okay, I'll give you a couple more minutes. There, maybe. Okay, good.
So
You're
what
on the
did we
right
get
track.
for this? Sorry, what did
Hi.
Hi.
We're done.
I guess that by the idea that Hassan is that like, what are we looking at, Hassan? What's so important? Are you checking your stocks again?
I swear. Professor, look at this ball.
Look
at this.
ball.
Look at this. Look at all red. Red. Everything's red.
Yeah. I don't know. What did you do? Did you just break the market? Okay, I gotta go to another room. You're all set.
What?
What are you going to recommend you do?
Product one?
Product one.
Okay, maybe. Do you have a name for it? You know, one of these days, I hope I go into a breakout room and people are shouting at each other and saying, no, that's wrong. That's not the MPV. No, I come into these breakout rooms and say, so
We were talking.
okay. Well, I'm glad to see someone is working the spreadsheet. Who's working the spreadsheet? Anna?
No. I'm typing into the chat of the numbers. They're doing the IRR.
Who's doing the spreadsheet?
Me, Kate.
Kate? Awesome. Okay, so you're literally typing in the numbers.
Yeah, I did them also.
We
So-
did the first one together.
Yeah, we did this
Beautiful.
one. And
So can you just click on one of the cells in the first one? By the way, the numbers look perfect, right? Your numbers look fine.
where do you want me to click?
Okay, so just press escape because you're in a cell right now. And go up to the second year, the net income of 811,000 and click on it.
Mm-hmm.
Okay, so that's a number, right? So
Yeah.
the power of Excel. So I assume that you all haven't used Excel.
I used Excel.
So Excel is just a calculator, right? It's a super uber calculator, right? It allows you to freeform do calculations, right? So it seems like you're doing all the calculations on your calculator and then you're writing in the numbers. So we're going to show you how to do all the calculations in Excel. So you actually don't need to use your calculator. Okay, but keep going. You're nearly there. Okay. I want to get the NPV and the IRR, right?
Yeah.
Okay. I will say that your 0 needs to be a negative, right?
Yes.
Okay. Okay. I'll give you another 5 minutes and then we got to move back in, okay?
Okay.
Okay, so I get that there's
How are we doing back here? Are we finished?
We have different NPVs, but we came to the same conclusion.
You got different, say that again, Callie.
We all have different net present values, but we came to like the same conclusion on which product to invest in.
Okay, which product?
One.
Okay. And so why do you all have different numbers?
I tried using Excel to find NPV with the net incomes and I couldn't figure it out. So I ended up just using my calculator.
Okay, and that's fine because there is a trick for NPV in Excel. It won't give you the correct number if you just highlight it. So.
Oh, okay. I did Excel and it gave me a much smaller number than the one from the calculator.
Yeah. Okay. All right. Okay, so you guys, it sounds like you guys are done. All right, so I'll call you back in. I was given, we've got about 3 minutes left, okay? If you want to go back into the main room, that's fine. If you want to leave the breakout room, did you come up with a name?
We'll come up with a name.
We're all set. We've just been chatting about COVID. And hold my dog.
I got Costco too.
Yeah.
Oh, you're on mute.
What did you say, Shelby? What were you talking
Oh,
about?
we're talking about Costco and wholesale food.
Okay. At least Tiff is brushing her teeth. That's good. Good dental hygiene. Panasonic toothbrush. Yeah, awesome. Very good. Okay. You can go back into you can leave the breakout room if you want. Did you
No, wait. I think you have it set up so that, like, if I click leave room, it says leave meeting, and that means that I get kicked out of the entire meeting.
Oh yeah,
you can
don't
set
want
up the breakout rooms,
Okay.
but I don't think we can leave.
Okay. That's pretty cool. You can't leave. Haha. All right. Well, I'll
Until you call us back.
I'm going to call you back in a minute. To come up with a name.
No.
Name for your product or company. Something more endearing than Pampered Pets.
Good.
Go on.
How come you guys were able to leave your room? I just went into another room and they said, "Oh, we're trapped. We can't leave." Did you guys hear me?
There was a button.
I clicked the leave, and then I had to rejoin the meeting.
Oh, you had to rejoin? Okay. All right.
No. So the first cost should just be reflective of the 750, right? So that's fine, right? That's okay. But for the next one, the cost is related to how many units you sell, right?
Yeah.
So it would be the 16,222.5 times 200.
Okay. Yeah, that's what it is. But like, how can we like put it to also be affected by like how many sales we're having? Because they're also increasing. So do we just
Yeah.
multiply by the 3% as well?
No, you're just multiplying it by the units because the cost stays the same every year, right? You're
Okay.
going.
All right, you all back? Awesome. Okay. How do we want to do this? So I know we need to take a break. I want to get this finished though before we take a break. So I'm going to go through it. So for each of your teams, can one person just type in what product you're going to do? Just what was your result? So in the chat, if you could just type in, okay, so 1111. Were there people who didn't get a definitive answer? Who just didn't have enough time? Okay. So no one picked 2. Not enough time. Okay. All right, let's do this. Screen share. Okay. Can everyone see my Excel? Hold on a second before I ask that question. I can't see you guys. All right, can everyone see my Excel? Okay, cool. All right, so we're going to do this. All right, so you should have, so I saw some people doing Excel good. It might be new to some of you. I'm going to show you. Excel is awesome as opposed to Google Docs. Google Docs is actually not that good. But I'm not sponsored by Microsoft. Microsoft does not pay me any endorsement, unlike the basketball players. So you need to learn how to use Excel, all right? Regardless of whether you're in business school or COM or CAS or CGS, you need to come out of BU knowing how to use Excel. It's like, okay. So let's start here. I'll also add in year 0. Okay. The first thing, I'm doing an income statement, right? So I want to see what my units sold are. Okay. So in year 1, how many units do I sell? I sell 15,750, right, for the first product. This is product 1. Okay. All right. And then it grows at what growth rate does it have?
3%.
Sorry?
3%.
3? Did you say 3? Yeah. Okay, so I'm going to type in 0.03 here. Okay. Now, here's the beauty of Excel. Year 2, I want it to be 3% higher than the prior year. So I'm just going to put in a formula that says reference that cell, multiply it by 1 plus 3%, and then press enter. And look, that's the number of units that I sell for the next period. Okay. And then I can actually get really tricky and I can lock that cell reference. So by putting $signs in the formula, it actually locks that cell, right? So now once I have the formula in there, I can just drag it across and look what happens. Oh, wow. Excel does that for me, right? And they're the units sold, okay? Okay, they're the number of beds that this first product would sell, okay? Revenue. Okay, what's the price? Let me type it up here. Unit price. How much does one sell for? Someone please tell me. I don't have the case in front of me. Stephen, you're having great fun there. Put yourself off mute and tell me what the frickin' price is.
I think it's 250. Let me check. Yep, 250.
$250. Yep.
Cost is 200.
Okay, now you're firing off all these numbers at me. Cost is 200. Okay, hold your horses. Okay, let's do this. So if I sold 15,000 units and the price was $250, that's my revenue, 3.9 million. Yep. And again, I'm going to lock in the price because the price stays the same if I'm correct, if I remember correctly. Okay. And I have that. Drag it across. Boom. Oh, I get these hashtags. Don't worry. It's just your column is too narrow. Okay. Cost. What direction is that? Costs. Is that money leaving my wallet or money coming into my wallet? Eliza, is that money coming into my wallet or leaving my wallet?
Leaving.
Okay, so let's make that a negative. And it's the number of units I produced times the cost, which Stephen told me was $200. Okay, so that's my cost. And again, I'm going to lock in that cell so it references it. And then I'm going to carry that across, drag it across. And then I'm going to just format it so it looks like it makes sense. Okay, everyone cool with that so far? And then my net income, someone give me another name for net income. Anna,
So you use revenue.
No, another name for net income. Come on, answer the question.
Turnover.
Yeah, if you're in England, it's turnover. You're in Boston, it's not turnover. Come on now. Net income. P word. First 4 letters are prof.
Oh, profit.
Okay. Woo! How about another term? Cali. What's another term for net income or profit? What's another term?
Net earnings.
Thank you. Okay, so then I add those two numbers together. One's a negative, so it's actually subtracting it. And boom, I get my net income. Great, I'm all set. Okay, that actually is the end of my income statement. So I saw some of you when you were doing your model, you put in the capital expenditure here in year 0 as a cost. So we actually don't do that, right? Because capital investment, if I invest in equipment, it stays for a long time, so it stays on the balance sheet. So therefore, it doesn't belong on the income statement. Instead, you will say cash for PP and E. And in this case, it was 2,750,000, right? 2.7 million, 75 million. Yeah. Is everyone okay with that? Does anyone want to say no? No, Professor Yukaka.
Shouldn't the expense be operating expenses? So doesn't that include it in the income statement?
Okay, so the operating expenses are here. This line item.
I thought the operating expenses also include utilities. That's why I thought the.
Okay, where's utilities? Did I miss that? Was that in the case?
Oh, I thought that the 2 million was a utility. Yeah.
The 2.7 is not utilities. It's the cost of the equipment, I think it said, right?
Okay.
Someone read out what it said about that. What's 2.7? What did it say that was? Savannah, you brought it up, so read out what is 2.7.
Oh, and yeah, bring it up. Sorry.
Okay, let's move on.
Okay.
Let's move on. Okay. Anyone got an issue with this number that I have here, 2.7? Cassie, what's your issue?
It needs to be negative.
Thank you. At least someone's paying attention. Okay. And now I can just add all these numbers together. This is the net cash flow. Okay. And from that, I can calculate my IRR. Okay. Let's do it really quickly. The second product will go a lot quicker, believe me. IRR. So in Excel, wouldn't it be great if we had a function that did that? So if I look in formulas, insert function, and I don't know what it is. Does anyone know what the IRR is? Why don't I look up IRR? Oh, and look, I have 3 different types of IRR. I just want plain old IRR. Values, what are the values? These are the values that I want to get the IRR of. Guess, I don't have to guess. 15% IRR, all right? Did you all get that? Okay, I see some people are nodding their head, 15.5, okay? But you should do it in Excel, okay? NPV is a little bit trickier because in Excel, every cash flow is at the end of the year. That's the assumption. But this 2.7 is actually today. It's at time 0. It's at the start of the year, if you want to think about it that way. So the way we do it, so it's asking for the rate. The rate is 0.15, right? Which we said is the discount rate, which is the interest rate on equity. And then the values are all these values. That's the net benefit. And then I'm going to have to add in the cost, which is that. Oops. So that's the IRR. Sorry, the NPV. All right, did you all get that as well? Okay, some people are nodding their heads. Awesome. Stephen is shaking his head.
Yeah, I didn't know you have to add the 2.75 after the range. I included it into the.
Yeah, so that's the problem with Excel. As I said, all the cash flows it assumes are at the end of the year, but that very first cash flow is actually it's at the end of last year, which is the start of this year, which is time zero, which is the present value.
All right.
Okay, just a little trick. Don't worry about it. Okay, that's product one. Oh my gosh, you mean to say I have to do this all over again? No. Let's copy this. Let's paste it. And now I have, let's rename it and call it product two. And what's the unit costs? Victoria, take yourself off mute. Tell me what the price is and what the cost is.
The price is gonna be 315, and the cost is gonna be 225.
Okay, is that? Did you say 350?
Yes.
Okay, thank you. All right, so now I've changed the prices, but you notice that my stuff is not changing. The units sold increased by 2%, right?
Professor, sorry, it's 315, sorry. So 315.
Okay.
Yeah.
That's what I asked. Okay. Units sold. Catherine, what's the growth rate?
1 sec. It is 2%.
Okay. So now each of these should grow at 2%. It's actually referencing that cell. So I just need to drag that down to reference that cell. And now it works. And now I can copy that across. Same with the price. The price is referencing the price above. So I just drag that down. I actually wanted to reference the 315. And then drag that across. Sorry. Drag it across. Boom. And then this one, there's the units sold. I don't want it to reference the 200. So I wanted to reference D22. Copy that across. Copy it back one. And they're the numbers that I get. That doesn't seem right. How much did you sell in the first year, Leah? How many units did you sell in the first year of this thing? Lip reading, and I think you said 9,650. I like to see it 50. Yeah. $60. Okay, you guys are not helping me at all, right? Guess not. Are you leaving me to hang out to dry by myself? Okay, all right. So on and so forth, right? Let me just see. I'm getting the right numbers. I'm getting the right numbers. What's the cash? How much does it cost for this equipment, Alexandra?
It was 3,250,000 negative.
Okay. Oops. 32 million. And you said negative. Okay. Okay. And so now I get this IRR, which is 12%, and I get this NPV, which is negative. And Xavier, what do we think about the negative number?
The negative NPV. Is that the one you're talking about?
Indeed. Thanks for listening in.
Not good, I guess.
Yeah, not good. Yeah. So therefore, Xavier, which product are you going to do?
Product 1.
Yeah. So the idea is it's a negative NPV, meaning the present value of the costs exceed the present value of the benefits. That's bad, right? We're losing money. So companies will look at these projects and say, you know, I won't be doing any negative NPV projects because it's taking value away from the company. I will do the positive NPV projects. It's adding value to the company. So they will do that, right? It's actually adding 15.5% of profit to the company, of value to the company. Okay? All right. Let's take 10 minutes break. Come back at 11:42. Steven's back.
Yeah, I have a question.
Okay.
On the test, there was just one question where I think it was a cash flow question, but I was wondering if it was possible to do it another way, where so basically the question was like, you're getting paid money, right, per year, and at the end of the payments, you get additional money, right?
Yeah.
Like a lump sum value.
Yeah, $6,000.
Yeah, I was wondering if it's possible if you just did like you broke it up into 2 sections and added the values together.
Yeah.
That's possible?
Yeah, you can do that, but just be careful. So
I know 'cause there's 2 different types of rates. I know for
so remember, it compounds. That one question compounded monthly.
Well,
Right?
there's 2 questions like that.
Okay, well, so if it compounded monthly,
Mhm.
So you'd value the annuity, and then you value the lump sum at the end, but you had to use the same interest rate of monthly rate
Mhm.
and the same number of periods. So I think it was 8 years, right? It was 96 months.
Yeah, 96, yeah.
Right, so you had to use the same, you just had to be consistent. But but another way of doing it was just to say the future value is that $6,000, and you could just do it in one step.
Oh, okay. Yeah, that's like the only question where I was like, I don't think I got it right.
Okay.
But I don't know.
Well, when you get your results back, you can come see me and we can talk about it.
Yeah.
Whatever.
Right.
Okay. Can you turn your videos back on, please? Okay. Are we back? Some of us are back. Some of us still gone to the kitchen getting some food. All about the food. Cassie got something to eat. I don't know, it was yogurt or something. Okay, good. Healthy food. All right. So it's a goofy little exercise, right? But if you think what a corporation does on developing products, they have a lot of people devoted to trying doing the analysis you just did. Actually trying to get the numbers to do the analysis you just did, right? If you think about what marketing spends its time doing, they spend a lot of time trying to figure out how many units do you think we'll sell? Because here's the thing, you don't want to introduce a product and then for it to turn out to be NPV negative, right? Because too many of those products, and before you know it, you're bankrupt, right? So that's the whole point of departments like marketing department, finance department, operations department. They all work together to try and figure out what are the revenues, what are the costs, and then what are the NPVs, right? And by the way, if you think, oh, I'm only going to do marketing, so I'll never have to do this, think again, right? Marketing people do this a lot. Operations people should be doing this a lot. Okay? Okay, let's move on. All right, so, we had a really simplified income statement. We just had revenues minus costs. But a more complex one, and this is actually not a complex income statement. Can everyone see my slides, by the way? Okay, so here's an income statement that shows more line items. And this is what it typically looks like. You have revenues, which I said was sales. And then you have what's called cost of goods sold, also familiarly known as COGS, C-O-G-S, COGS. And COGS, if revenues are the variable, revenues are the variable benefit I get, COGS are the variable costs that I get, right? So usually that's, what would that be? For Dunkin' Donuts, what are their COGS? Someone just unmute yourselves. Come on, unmute yourselves and shout out some answers. Dunkin' Donuts, what are their COGS, variable costs?
Batter.
Batter, is that what you said, Alex?
Yeah.
Batter, right, flour, oil, etc. Yes. What else?
Coffee.
Coffee beans, yeah, they have to grind the coffee. What else?
Milk and sugar.
Milk and sugar. Milk actually is super expensive for Dunkin' Donuts. Julia, I missed what you said. The what? The cups? Yeah, okay, the plastic cups. Okay, keep going. What are the variable costs? Okay, we got all the materials, the direct materials. Coffee, sugar, milk, donuts, flour, sugar, 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 sugar. Sorry. What other variable costs does Dunkin' Donuts have, guys?
Building rents.
No, the rent, they pay the rent no matter what.
Oh.
But for here's answer this question. What are they going to pay on a variable basis, right? That's proportional to the number of donuts they sell, right? So rent, they're going to pay that whether they sell 1 donut or 1,000,000 donuts.
Can it be advertising?
No, they're going to pay no, in the short run, advertising is not variable. Come on, guys, you've all been in Dunkin' Donuts, or maybe, sorry, Starbucks if you're fancy. What the heck is in Starbucks apart from coffee and sandwiches and crapola? Xavier.
Huh?
You took yourself off mute. You want to say something?
Oh, that was an accident.
Oh, come on.
They have machines.
Oh, they have machines. That's right. They have machines to serve people. Seriously, guys.
The employees.
Alexandra, as they would say, no beep, Sherlock. Yes, of course. If they're only selling 5 donuts, they're not going to have 15 people in Dunkin' Donuts. They're just going to have 1 person, right? So labor is another variable cost for most businesses.
But Professor, that could also go like with that thinking, that could also go for like electricity.
Okay, so here's the thing with Dunkin' Donuts. Once the manager goes in and opens up in the morning, they turn on the lights all the morning. Regardless if they sell 1 Dunkin' Donut.
The machines that they use.
Okay. Hassan, sure.
Okay,
Why
okay,
not?
I'll let it go. I'll let it go. It's fine.
No. Let's not let it go. Sure, you're right. Yes. It's usually not a huge amount of electricity. I know. The deep fat fryers that they dump that donut in. All right. Okay. Variable costs. Sgna, selling general and administrative, abbreviated as Sgna. That would be things like, okay, come on, take yourselves off mute and tell me what they are. Some of you mentioned some of them. So Hassan, usually it would be utilities. Usually utilities would be in here. Other ones.
Salary
Of whom, Coyle?
of the employees.
No, so I said that the people who are actually giving you the donuts, their salary is actually in here in the cost of goods sold.
Of the managers.
Okay, of the who? The CEO, the CFO, the chief marketing officer, the marketing department. They're all in here, right? Good. What else?
Would rent be one?
Rent indeed would be one. I don't know who said that, but that's a good one. Rent would be in there. Insurance, utilities, rent, advertising, etc., etc. Cool. Also depreciation on their equipment might be in there. All right, and then you have interest expense. That's money you might be paying on your debt. It's a financing cost. and taxes. That's what you pay the government, right? Okay, okay with that? Any questions on that? So we come up with these lines that are the calculated lines: gross profit, operating profit, and net profit. Net profit being the bottom line. Operating profit being the profit you get after all your operating costs, but before things like taxes and financing costs, right? Which are sort of independent of how you operate the business. Okay?
Operating costs are costs of goods sold and fixed costs.
So operating costs are cost of goods sold and fixed costs, yeah. And that once you take those away from the revenues, you end up with the operating profit. Okay? Okay, so these are going to be important metrics that we're going to have to look at. Once the company has net income, it can do two things with the net income. The first thing they can do is they can pay a dividend to its shareholder, right? So investors invest in companies so they get a return, so they get some money back. Or maybe they're hoping, like Hassan, that the stock price goes up and up and up. Yeah. But sometimes they might hope that maybe the company will pay me a dividend. Okay. So if you have net income, the company could pay a dividend. The other thing they could do is they could keep the money. If they keep the money, what are they going to do with the money? So let's think about it. Starbucks. You all know and love Starbucks. If they keep the money, what are they going to do with it? If they retain the earnings, what are they going to do with it? Queena. What does Starbucks do with the money they keep?
So they keep to like invest for next year.
Okay, so what does that mean though? What does it mean to invest for next year? What are they investing in?
As a capital into their company.
Yeah, I'm looking for a tangible answer of what are they actually investing? What are they putting their money to?
Their products.
Their products, right? So they're developing new sandwiches, right? That Queena and I can buy. And croissants, I love their croissants. Tiffany, what are they investing their money in?
Sorry, can you repeat your question?
Niharika, what are they investing their money in?
They're investing their money in, they could be in marketing and advertising too.
Okay, so a little bit in marketing and advertising. Who else? Jayu, what are they investing their money in? That's not, I'm looking for something very specific. And it's where most of their money goes. Jayu. No?
I'm not sure.
They can offer pay raises or promotion.
Okay. Sure. Maybe. That's not what I'm looking for. What is the what?
Is there more like more shops or something?
What, Damien? Awesome. Thank you. No kidding. What's the big joke? Starbucks just opened a new Starbucks in the bathroom of the Starbucks that I go to. That's how many Starbucks there are. Think about Questrom. I know maybe it's been a while since you've been in Questrom. I'm going to start ranting. How many Starbucks are there within a walk of Questrom? Oh, let's see. There's one on the second floor. There's one in Kenmore Square. There used to be two in Kenmore Square. There's one over by Warren Towers. There's one down. Oh my gosh, so many Starbucks, right? To open up the Starbucks, they need a lot of capital, more than they need for marketing, more than they might need for pay raises, more than they need for the new croissant that they're going to develop. All right, everyone get the picture? Okay. So if they had $100 and they paid 60 in dividends, that must mean that they kept $40 for the company itself to invest in new stores and new products. Okay, retention rate therefore is 40 divided by 100. So that's what we call the retention rate. How much of the earnings do they keep for themselves? When I say for themselves, I mean for the company. They didn't keep it for management. And then the dividend payout rate is 60%, right? So dividends of 60 divided by 100 is 60%. And therefore, note that your payout rate plus your retention rate always has to equal 100%, right? You have to do something with all your earnings. You either pay it out as a dividend or you keep it in the company to reinvest it.
I have a question.
Yes.
So how do companies decide how much they're gonna pay for dividends and how much they're gonna invest back into themselves?
Great question. That is super difficult to answer. So they are very cautious about how much, what determines it is the dividend, right? So they want to figure out the dividend and then the retained earnings that falls out. So they first determine the number of the dividends. And companies are very reluctant to increase dividends because the last thing they want to do in bad times is decrease dividends, right? If they decrease their dividends, it means bad things are happening, right? So they will be very cautious about how they set their dividend. But what they will do, Julia, is they'll kind of look at what other companies in their industry do, and they will match it because they say, oh, you know, if Nike is having a dividend yield of 2%, let's say, then Reebok, or whatever they're called now, Adidas, Reebok, will say, oh, I need to pay approximately the same dividend. So they'll say, oh, maybe 2% is good. And actually, they'll pay investment bankers to do this study for them on dividends and what that should be, right? So there's a bit of science in there, but then there's a bit of art that goes into it. But it's not an easy, it's not like, oh, it's automatically 5%. No, it depends. Okay, good question. Anything else on that? Okay. If they keep some of their money, they retain some of their money, they will reinvest it in the company, and the dollars they reinvest will make a return. And we call that the return on investment, also known as the ROI. Kate, you're from Europe. Do you know what ROI stands for?
No.
Where am I from, Kate?
What?
Where am I from originally?
Oh, Ireland.
Republic of Ireland. Ooh, ROI. Never mind. Let's move on. Return on investment. Okay, if we do this example, Go Terriers had $200 in net income last year. Okay. If they kept half of their earnings, how much did they retain in the company? Cassie?
50%.
Yes, that's what I'm saying. How much in dollars?
Oh, $100.
$100, yes. Okay, $100. Clear? I paid out I earned $200. I paid out 100 as a dividend. Therefore, I kept 100. Okay. If the return on investment is 5%, Chia, how much does the earnings increase by? It's much easier if you press the space bar and take yourself off mute. Then we can hear you, Chia.
100.
Say what now? How'd you get that? Goel, help us out here, baby.
200 times 0.5.
No, that was the first question, which Cassie answered. right? I'm asking you the second question, second bullet point. If its return on investment is 5%, how much does earnings increase?
Oh, so wait.
Okay.
10.
Okay, so I know it's been a tough week. All right, but we're getting near the end of it. Here's the idea, Cassie. Sorry, Tia. I had $200 in profit. I paid out 100 to the shareholders. It's gone. They spent it. I kept 100. That 100 earns 5%. See this formula? The dollars reinvested equals times the return on investment. Our earnings will increase by how much?
5.
$5. Thank you. Okay. All right. Last question on this page. What would the resulting net income be this year? Tiffany. Come on, Tiffany.
Net income will be the 200 plus 5.
Yes. Awesome. All right. Usually people just say, well, just be 5. No. They earned 200 last year. It's reasonable to expect they will earn 200 this year. Plus, they've invested in this new business, so they get 205. Is that clear to everyone? That's why companies reinvest money, is because they want to make more money. Yeah, more money wants to make more money, and so on and so forth. More money. Audrey, who are you talking to?
I'm talking to my sister explaining your hilarious jokes. I'm sorry.
Well, that's kind of hurtful that you have to explain my jokes. Oh, hi, sister.
Oh. She's walking in and out. I'm just filling her in.
Hey, does she take finance?
No, she just graduated from the Air Force Academy, so.
Oh, really? That's why you're in Colorado, where the Air Force Academy is. Well, congratulations to her. Tell her thank you from all of us at Questrom.
Oh my gosh, I will.
Okay. Okay, let's move on. Any questions on this? That's why companies reinvest earnings. Okay. Okay, I need to develop tools that'll help me analyze the company. It's interesting to know how much profit I will make, how much operating income I will make, but I really need to know other metrics that will measure the health. So what we do is we calculate what are called margins, right? Gross margins and profit margins. And it allows us to see how we're doing relative to competitors and over time if we're getting better or worse. Okay, so I'll show you what the margins are here. In this simple example, we have sales of 100, cost of goods sold is 60, gross profit is 40. Therefore, our gross margin is 40 divided by the sales. Whenever you say margin, it's something divided by the sales. So it's always something divided by the sales. So it's 40 divided by 100, 40%. So the gross margin is equal to the gross profit divided by the sales. Similarly, the operating margin, in this case, it's $15 divided by the revenue. So that is 15%. Last one is the net margin or net profit margin, usually just called the net margin. And so it's your bottom line, $10 divided by your sales, $100, that gives us 10%. Okay. Everyone okay on how to calculate those? Okay. Okay, so now I've figured out how to calculate them. Let's look at this example. Here is company ABC. And here's their results for 1, 2, 3 years. And actually, watch out for the order. This is the earliest, 2003, 2004, 2005. So some companies will do that. They will put their most recent results in the first column, okay? So you can see the gross profit is going from 27 to 29%. And my net margin is going from 2.9% to 4.3%. So you as an analyst, as a financial analyst, might be trying to figure out, well, what's going on? So the first thing you can do is you can look at a single period and you can see what percentage of my revenue do I spend in COGS? Well, I spend 70% on variable costs, right? With that piece of knowledge in hand, you can then go out and you can say, okay, let me benchmark myself to other companies and see if they're spending more or less than I in cost of goods sold. And that'll tell you something, right? If I compare New Balance, does everyone know New Balance? It's a Boston-based company, sneaker company. And if I compare them to Nike, which do you think would have a higher gross profit? I.e., which one do you think would have lower direct labor and direct materials? Which do you think has lower? Audrey, you want to say something?
I feel like Nike would.
Why? I agree with you.
I'm not sure if this is the right reasoning behind why, but doesn't New Balance make and produce all their stuff in the US, so it would be more expensive?
So actually, they don't produce everything, but they do produce a lot of it. They, for example, they have a manufacturing plant in Brighton, just down Commonwealth Avenue. So as a result, Audrey, their cost structure is higher. So therefore, New Balance, you might expect to have worse gross profit margins, okay? So that's the right reasoning, okay? Perfect. So you can do things like that and you can figure out, well, what's the story? Yeah. Another thing you can do is you can say, hey, let's look at it over time. So if I look at this, it looks like my margins are going from 27, 28, 29. Okay. Jiayu, I'm coming back to you. What do you think is happening here? Is this good, bad, or indifferent? And if it's good, bad, or indifferent, why?
I think it's different.
Say again? It's different.
I think it's different.
Indifferent. It's meaning it's not changing. Indifferent.
Yeah.
Okay, so the gross margin is going from 27% to 29%. So whenever this moves by 1%, it's like it's a significant deal, right? If Nike's margins improve by 1%, it's happy time. It's good stuff, right? So the margins are increasing, so that's awesome, right? Yeah, do you agree, Jiayu?
Yeah, I know.
Okay. What it's saying is that their cost of goods sold as a percent of revenues is going down over time. It's so somehow maybe their costs are getting lower. Maybe they're getting cheaper labor. Maybe they're offshoring more. That might be one reason. Maybe the materials are getting cheaper. Maybe the price of oil is going down, and that's one of the main inputs into making sneakers, right? So maybe that's one reason. Or maybe they're actually being able to charge more for a sneaker as opposed to... Hassan, what's up? What's so funny? Come on, baby. What's funny? What's the joke?
So my mom came into the room to she needed something from my room, and then she was like, "Are you on video?" And I said yes. So she crawled under the camera to get what she wanted. So it was fun.
She went into commando mode.
Yes.
Okay. Is class near over? Please, please let class be over. I'm just kidding. I love this class. I love you guys. Okay. All right. You okay with gross margins? So you look at it over time, but then you can also benchmark it to other companies, right? So let's look at this example. Here you got two companies. Company ABC is over here, and these are their margins, and company XYZ. And so you can see that XYZ is considerably larger than company ABC, right? So I can't compare the two really in absolute dollars because this is huge compared to 35 is tiny. But I can compare margins. I can say, okay, my profit margins are 35 versus the other big competitor is 37. What's the difference? Well, it looks like actually on a gross margin basis, I'm better. My gross margin is higher than the bigger company, but it seems like I have a lot of expenses, operating expenses. So maybe I pay my CEO more. Maybe I have a bigger marketing department and marketing budget, okay, on a relative basis. Right? Questions on that? Okay. All right. So now we've looked at the income statement. We looked at revenues minus expenses equal to my net income. Now, if you're a shareholder in a company, let's say I'm a shareholder of Apple Corporation. Do you all know Apple? I think they make phones and stuff, and computers maybe, not sure. So if I'm a shareholder, I'm looking at Apple's income statement and they made billions, right? Billions of dollars in net income, let's say. I don't know exactly how much they made, but let's say it's a big number. I'm a shareholder. Do I go, yippee, I own billions? No, I don't. I say, well, that's great, but I'm actually more interested in what's my portion of the billions of dollars that Apple made. So therefore, in order to help me think about that, companies will say, well, how much did one share make? And so they'll express things on a per share basis. They'll express dividends on a per share basis. They'll express net income on a per share basis. So that's what we call the earnings per share, or EPS. Okay, and the EPS is simply what's your total net income divided by the number of shares outstanding, right? And as you might imagine, Apple has like millions of shares outstanding, right? Because a lot of people own it, own a portion of the company, yeah? And it's a big company. Typically, the bigger the company, the more shares outstanding, right? Because it needs more capital. It needed more capital when it was started. Okay? Okay, here's Cheesecake Factory. They have 49.567 million shares outstanding. What is their EPS? Okay, you guys do it quickly. And type in the window your answer. Type in chat what your answer is. And I want to see it in units as well. I want to know what your units are. Okay, Eureka, Grace, Queen, Queena, beautiful, Damien, Shelby. Come on, let's go, Eliza. Oh, there's someone giving it 4 decimal places. Thanks, Savannah. Dagny spells it out, dollars per share. Excellent. Hassan per share, beautiful. Okay, 2.04, right? Okay, so this is how we do the calculation. The net income is 101,000. No, it's not 1,000. If I look up here, all these numbers are in thousands, so it's actually $101 million. That's a lot of cheesecake. And then the number of shares outstanding, we're told, is 49.5 million shares, right? Is anyone confused with this M here? Does that M stand for millions? It can't, right? Because that would make this 49 billion, right? What does M stand for in finance terms? Okay, maybe you all know this, so I won't go over it. Does anyone know? Okay. Does anyone watch Super Bowl ever? No. Damien is no. Don't watch that. It's a silly game. It's not like soccer. Stephen, do you watch the Super Bowl? What was the last Super Bowl called? What was the number?
Not too sure. Maybe 50.
50. Okay. How did they say it? L2 LII or something, isn't it?
Yeah.
Okay. It's what is it? Roman numerals?
Yeah.
Okay. So this is Roman numerals. So in finance, if you ever see MM, it means thousands, which means $1 million, right? Okay, let's move on. Here's another question related to Cheesecake Factory. That's their earnings per share, and that's their dividend per share, right? So if I own 1 share, I'm like, woohoo, they earned $2.04. But then the company says, okay, of that $2.04, I'm going to pay you 61 cents. What's their dividend payout rate and what's their retention rate? Quickly, please.
The dividend payout ratio is 0.61 divided by 2.04.
Okay, that's what I'm asking you all to calculate. Thank you. Thanks, Damien. You
Oh,
spoiled
sorry.
it.
Sorry, I didn't know that you meant to like put it in the chat.
That's okay. Don't worry about it. We're all good. Okay, beautiful. Kelly, you got it. You brushing your teeth while you're doing this class? Oh, it's a spoon. Okay. Whew. Okay. So you've all said the payout rate is about 29.9%. So you took 61 cents divided by 2.04. And then the retention rate has got to be 2.04 minus the 61 divided by 2.04 again. So you can see that 29.9 plus 70.1 has to equal 100%. Yeah, it has to equal 1. All right, everyone okay with that? Okay. All right, so, and then we're finishing up here. Okay, there is actually a whole worksheet that I never got to. So I would encourage you, if you're looking for more questions, is go to that worksheet and do it for yourself. It's on Questrom Tools. It's under worksheet and it's called Class-7, I believe, worksheet. And it's 2 pages. It's more data than its questions, right? It asks you what the EPS is. It asks you what the payout rate is. Okay, any questions? I'm going to finish the class at this point. I think we're all a bit pooped. I can sense people are just glazing over.
Professor, can you go back to the slide where the retention rate, you had the formula for the retention rate?
No.
Not the formula, like how we found it.
No, I'm just kidding. Yes. Yes?
Yeah.
Have you got a question on it, Hassan?
I just want to know how to find the retention rate. Like, I just want to write down the formula.
Yeah, so it was the earnings minus the dividend. So if I didn't pay it out as a dividend, the company must have kept it. So in this case, they kept $1 and what is it? Can't do the math. $1.43. They kept $1.43 in the company. $1.43 divided by 2.04 means they kept 70% in the company.
That's what they reinvest in the company?
That's what they reinvest in the company,
Okay.
exactly. So in Cheesecake Factory, again, they probably went out and built out more stores, right? Expanded. Maybe not in the US, maybe overseas.
Thank you.
Any other questions on any of this? So I do encourage you to do the worksheet, right? Oliver, tell us about My Finance Lab. What prize do we have for these good contestants today?
Yeah, just the same thing that's due on Tuesday. Just the one.
Just one My Finance Lab due on Tuesday.
Yep.
Don't wait till the last minute. Do it over the weekend. If you all have questions after the exam results come out, feel free to reach out. If you've all got questions about, if you're in that situation where you might need to consider a W, feel free to reach out. I can't tell you definitively, but we could talk through it. Okay? That's all I got for this week. Peace out. Love you guys. Hang in there. Keep going.
Thank you, Professor.
Thank you,
See ya.
Professor.
Good weekend. Bye-bye.
Thank you. Oh, I have a question.
Okay, you can stay on at the end if you want to stay on at the end. If you want to chat, just hold on a second.
Okay.
Oliver, you good?
Yeah, I just had a question. You said Jan Hu was here earlier.
Yeah, he was.
Okay, because he left like half an hour before we took the break.
Okay.
You still want me to mark him as present?
I thought he was. I thought I saw him. Hold on a second. Because I was looking for that other person in the background, right? That was the person?
Yeah.
Yeah. Yeah, you can mark him. I'll tell you what, I'll check on the log afterwards because I can see when he logged on and logged off.
Okay.
So I'll check on that. Okay, and I'll get back to you, Oliver.
Okay.
Okay. Let me just bear with me a second. Okay. Thanks, Oliver. Have a great weekend.
Yeah, you too. See you Tuesday.
See you Tuesday. Bye.